That's a big issue. When you think about, how do you grow an economy? It's labor, it's capital, and it's productivity. And you take one of those, reduce that, then you don't get as much economic growth.
I believe that what happened on the 27th is less of a story about DeepSeek.
DeepSeek, the Chinese AI startup.
DeepSeek is such fundamental change to the economics of what's going on.
The Chinese AI app, DeepSeek.
One of the stocks I like for this year is Palantir, and I probably should have made public that I liked it last year.
You certainly saw some parabolic moves in some of the power suppliers, in some of the AI infrastructure players of electrical equipment that couldn't really be justified by current earnings.
The policies of cutting corporate taxes, one side ran on deregulation, one side ran on more regulation.
Deregulation, love the potential for lower corporate tax rates.
I'm looking at a crude oil chart with 6 of 8 days lower, and they're going to take credit for immediately dropping the price of crude oil as soon as they took office, which I think is hysterical.
Does the Fed, should they be tightening in your mind? And is part of the fact that they're spending money like drunken sailors part of that?
Look, we cannot ignore the fact that
Welcome to the Future's Edge. I'm Jim Iuorio. That's Bob Iaccino. And if you look closely, you can tell that we have a special guest who keeps us in line because one, Bobby doesn't have a black t-shirt on. Two, I've worn a collared shirt. That's how much respect we have for our guest, Cameron Dawson, Chief Investment Officer of New Edge Wealth. But before we get to Cameron, a couple things we got to do. We want to thank our sponsors. This podcast is brought to you, one, by Independence Arc Farms in Arkansas. Grass-fed, grass-finished beef. It is amazing. If you guys have been watching my Twitter rants on Sunday night when I cook a new, different type of steak, last Sunday it was their filet mignons, and I literally, they were so good I wanted to write a poem about them. Check out Independence Arc Beef. Secondly, Hardcore Italians, go to their website for really funny Italian gear for the Italian or wannabe in your life. Use our promo code for 15% off. Bobby, what's our promo code? FU. It's for Finance Unfiltered, you pigs. I don't even know why your mind would go to where it just went. Anyway, we are back with Cameron Dawson. Cameron, how are you? It's so nice to see you.
I'm honored to be here. I'm honored that you would make such a grand sartorial effort for my preference. So thank you.
Thank you.
But now I'm hungry and I want some steak. And I don't know, maybe some like Florentine Italian steak. That would be amazing.
That would be fantastic. There was something called an arm roast, which I was not very familiar with that cut of meat that I got from Independence Arc, another plug. And my wife made it into like a stew last night. It melted in your mouth. I wish I had a video of that too, because I just did the filet mignons and the ribeye, which is my favorite cut of meat. It's so funny. People were like, okay, these guys give you meat. Of course you talk about how great it is. We've been talking about meat for 3 years on this show. We just found the best meat, and now we're to share it with you guys.
Entire shows.
You gotta find the best meat.
Yeah.
As I pull up cattle futures.
Exactly. And like I was looking for the best burger for 30 years, and when I found the place that served the best burger, you know what I did, Bobby? I bought the restaurant. Yes. Yeah.
Did you know that cattle futures have soared by 15% in the last couple of months?
Yeah, I have. I do. That costs us a lot at the restaurant. Yes. Yeah. You know what's funny about buying beef too at the restaurant too? When they go up, we'll see that in our costs, in the next couple of months. If they go down, people just seem like they forget to lower the cost. It's really weird. Yeah.
I don't know how that works.
Yeah. Anyway, how are you? Everything good in your life?
It's been great. We're running 1,000,000 miles an hour and markets are certainly keeping us busy. So excited to talk about them.
Speaking of which, okay, we had a 5% plunge in the NASDAQ yesterday. Seems to have recovered a little bit today. Again, you guys aren't seeing this probably for about a week. We will talk about broad themes. I'm talking about the plunge on the 27th. Do you think that was just a normal kind of shaking of the tree, trimming the edges, whatever metaphor I want to use?
I think that what we learned from the NASDAQ sell-off, from the chip sell-off, from the power supplier sell-off, from the AI infrastructure sell-off is how tightly wound this market had become, how concentrated it had become, and how you had a lot of moves on a year-to-date basis that were really hard to justify. And the phrase I heard today, there was a great analyst from JP Morgan said, well, some of our stocks went up 20-30% year-to-date and nobody knew why, but nobody was complaining. So I guess it's not that much of a deal when they drop 20% in a day. But when you think about investors who have chased into that, and I thought that the stat was fascinating that we saw one of the largest inflows into the semiconductor ETF just last week, right before all this happened. Clearly you are catching people flat-footed. And I think it also speaks to how much people had extrapolated today's demand, extrapolated today's power needs, extrapolated today's compute power into forever in the future and said we can continue to justify that. And doesn't that resonate or sound a little bit like what happened with, I know it's very different in its extreme in its extremeness, but what happened with Cisco back in the 2000s, where you did extrapolate and say, of course, they're going to become larger than the US economy and their earnings. So clearly lessons maybe were learned yesterday and then forgotten today as things have rallied. Who knows?
Yeah, part of the reason I find this interesting. So number one, one of the stocks I like for this year is Palantir. And I probably should have made public that I liked it last year. I didn't actually own it until about the middle of the year.
Well, we only talk about our winners.
Right, of course. We have no losers. Why would we talk about something we don't have? But anyway, go on.
Well, it's actually funny because I part of the reason you talked about, like, we don't talk about our losers, and people look at it. And the guy from JP Morgan said, oh, up 20%, down 20%. I guess it's not that bad. Cameron, you and I had a conversation a while back, sort of offline, about how people will love to just beat on you when you're wrong for a tiny period of time in sort of the universe of markets, right? I think we talked about it in Orlando. And, the reason I bring up the Palantir thing is when you looked at Palantir, not only did it not drop as much as the rest, nor should it have because of the sort of thesis as to why NVIDIA was dropping, but it rebounded quicker. And you mentioned Cisco. We talked about it on multiples of our shows, how it took so long for Cisco to recover from the rally that it had in the 2000s to get back to its all-time highs. It took longer than anybody else. Do you see any of that happening now other than NVIDIA? I didn't think Palantir was as overvalued as NVIDIA was, which is why I bring it up. Do you see anywhere else other than the chip sector that could get hurt if and when the chip stocks take a serious downturn that lasts?
I have no view on Palantir as an individual company. Mm-hmm. I can see the stock and how it's traded. And I'm reminded of Bob Farrell, the great Bob Farrell of Merrill Lynch, who said stocks that have parabolic moves higher can usually go on a lot longer than you think, but they don't correct by going sideways. They correct by going straight down. So whenever you see a chart like Palantir, you have to be aware that as you have had a parabolic move upward, you can have just as sharp of a symmetrical move downward. And that is what you are signing up for in being invested in that kind of stock. So whether there's a fundamental reason behind it or there's some re-rating, I don't know. You certainly saw some parabolic moves in some of the power suppliers and some of the AI infrastructure players of electrical equipment that couldn't really be justified by current earnings, but there was a lot of hope that it would cause a big inflection in future earnings. The question was how much was secular versus a cyclical build out of this kind of data center technology. It's a very interesting debate. But I think that I always remember as a kid, my dad saying to me, pigs get fat and hogs get slaughtered. And so when you have these kinds of parabolic moves, it's a good reminder to understand how much leverage you have, because that, of course, can bite really hard when something is down 17% in a day. And be aware of just the inherent risk of owning something after it has had this magnificent of a move. Doesn't mean it can't continue. I have no say in the matter, no skin in the game, but things.
Real quick, if I could, you mentioned Bob Farrell and that stocks that go straight up don't correct sideways. Just for people who don't know what that means, because Jim and I actually have talked about this with our technical analyst, Mike Arnold friend. Did I say that right? Our friend who's a technical analyst? It doesn't fucking matter. People don't understand sideways corrections. They just look at a stock and say, yeah, I bought it and it went up a little and now it's doing nothing. Can you explain sideways corrections for people who don't know what that is?
Well, so sideways corrections do happen. We usually call them basing patterns or consolidations. And the reason why it is correcting is usually the stock is still seeing earnings growth, but it's not going anywhere. The price is not appreciating, which means that oftentimes it is a function of just how expensive the valuation got. So when PE multiples amplify a move higher, maybe there is a great earnings story behind it, but because there is so much energy and excitement around a stock, you see this big PE multiple expansion, and then the stock just flatlines. And as it flatlines, it's growing into its multiple. And you'll see is the multiple will compress over time. If earnings continue to grow, then eventually you get into an environment where that basing pattern, that consolidation pattern, can set up for the next leg of the move when you get a spark of excitement and earnings come in maybe better than expected. The point of the Bob Farrell quote is just to say straight lines up are usually not followed by straight lines sideways. They're usually followed by straight lines down. So it's just a thing to be aware of as we're moving through 2025.
So there's two things I'd like to say, because I'll just give you my opinion on something and I want you to comment on it. I believe that what happened on the 27th is less of a story about DeepSeek or whatever the hell the Chinese company is, and more of a story about just positions that were disproportionately vulnerable based on how stretched they were. Okay, is an interesting story, and all of a sudden we collapse. But secondly, I think that we are foolish. There's a point now where the Mag 7 and AI stocks have led us higher. There's a point that they get past where to think that there can be this elegant, graceful rotation into something else without having broad market disruption, I think is foolish. Do you agree with either of those two, or one of them, or where am I stupid?
Yeah, I agree with you 100% on the latter. And Barry Bannister at Stifel, who is one of the most extraordinary market strategists on the street. I'm a big Barry stan. And he has been making the point that usually these periods of leadership rotations have a certain violence to them. They have a certain degree of pain to them. And that's not surprising from, let's say, the index level perspective, because the index is so heavily concentrated in these names. You can have a day like the 27th where the index was down, the average stock was up, and breadth actually improved on the day, but the overall index level was down. But most people own the index, so they're still feeling the pain. The other aspect of it is individual positioning. And one of the things that's happened over the last 2 years is that you've seen individual positioning within tech, or the flows into tech has been extraordinarily crowded. So it's tech or nothing else, tech or bust. And so the individual pain that happens in those rotations where people are very one-sided in their trades, you had that experience in the 2000s. People were all in on tech stocks. Nobody cared about value. Nobody cared about cyclicals or small cap or international. And people felt the pain of those rotations a lot more because they were overweight all the stuff that was doing really poorly, which brings up another great quote from Walter Deemer. And I keep his book. It's actually immediately below my computer because I was just reading through it today. But Walter Deemer, it's his law of perversity, which is the market will do the thing that causes the most amount of pain to the most amount of people at all times. And so when you look at these positioning stats where it's tech or bust, you have to be appreciative to your very point, Jimmy, is that you can certainly, it will be painful as you rotate away.
So do you think then that the Mag 7 AI, for the time being, that trade is over?
No, I don't think it necessarily is. We've seen a lot more dispersion within the Mag 7. I think it all comes down to earnings. And so earnings within the Mag 7 have grown 125% over the last 2 years.
Jeez.
Compare that to the equal weight, it's been a whopping 9%. Wow. So it's not to say that the earnings growth rate is set to slow significantly for the Mag 7, which means to me the starting point is Mag 7 dominance and performance is going to fade. So your best case scenario is that it still outperforms, but by a far less big of a margin than you had in 23 and 24. Right. Then the question comes, can the 493, can the value, can the equal weight, which is expected to see a big earnings acceleration. Equal weight is expected to go from 1% growth last year to 11% growth this year. Can we get that acceleration in the 493 or the other stocks. And that's the big show me story of this year. And if that doesn't materialize, then we could be in a world where Mag 7 is still outperforming on an earnings perspective in aggregate, but the degree of outperformance on the stock basis is just not nearly as much, because the other aspect, and I think it's an important point, Mag 7 earnings have just been consistently revised higher. And I think we're probably far more well calibrated on where earnings estimates are today for Mag 7 than we were those 2 years ago, which again speaks to much less outperformance. So your best case scenario for Mag 7, we think, is just a little bit of outperformance versus the whopping outperformance that we've had.
Bobby, I'll get you in just one quick more question. But first of all, when you said 493 the first time, like I was bouncing that around my head. I thought it was maybe a retirement program and there was passive investing. And then I was like, wait, 500 minus 7 equals 493.
You are so smart.
I'm sorry.
You are so smart.
Yeah. Anyway, okay. So another argument I've been making, and then Bobby, come in on this too, is I've been arguing that I think the market, corporate sector, I don't, not political at all, but I'm interested in policy. The policies of cutting corporate taxes, one side ran on deregulation, one side ran on more regulation because of environment and because of these things. It is not radical to suggest that the market will like one president better. However, I think that transitions are tough, even if we think we're going from a bad situation to a better situation. If the transitions are abrupt or too aggressive, the market could stumble a little bit. Do you think that's a legit worry?
100%. One of the things that we included in our outlook is this idea that the policy mix that was being anticipated by the market was all the good stuff and none of the potential challenges. And there are potential challenges that some of Trump's policies present. Sure. Love deregulation, love the potential for lower corporate tax rates. We don't think we're going to get lower corporate tax rates, though. We don't think it's possible from a budget perspective. Maybe we can be surprised, but the bond market, I think, would react very negatively to an even bigger tax cut. You're also, what would the pay for be? Would it be tariffs? If they do pursue that, that's effectively a regressive tax on consumption, and so it reduces growth. So you have a lot of issues with that lower corporate tax rate that we're not sure we're going to get. So yes, we would love those two things. And I do think that, to your point as well, business sentiment has improved a lot. And you heard it at Davos last week. All the business leaders were very bold up and said, look, it's green light, go. And animal spirits are a real thing. If you don't feel good, you're not going to spend on big projects and you're not going to hire more people. So you can have a self-fulfilling prophecy of the anticipation that things will be better will actually make things better. There is that aspect. But then comes the pain. And that's where we're not certain that the market is fully pricing things in. We think immigration is a huge wild card that could potentially be very disruptive to the U.S. labor market, as well as the projections for potential wage growth. One of the reasons why we've had immaculate disinflation over the last 2 years is because you had a true influx of low-cost labor. And that low-cost labor helped make productivity statistics look better. So we can talk about the costs of having that wage disinflation and the cost to local communities, and we can talk all about that. But we have to appreciate, if you start restricting labor supply, then overall economic growth could slow unless it's made up by productivity, but you're reducing that source of low-cost labor. So we think immigration is this wild card risk to economic growth in 2025. Maybe it's a 2026 story. So I do think policy, much more so in the last 3-4 years, I think policy has a much bigger potential to change the market outcome and the economic outcome than what was in the last administration. And it could be for the good or it could be for the bad. And I think that's why we have to remain nimble.
Yeah, 100%. I think it was animal spirits. I mean, that's what I wrote down here as Jim was answering that question, is this is almost the definition of animal spirits was Trump's election, right? Lower taxes. And actually, one of the places where I think you see it, and this is to you, Cameron, is the small business index, right? The optimism index. Small business shot through the roof, over 105, highest since, I believe it was mid-November 2018. I think that's what I saw. It was definitely 2018. So do you think it means anything, meaning the small business index, optimism index, typically for the stock market, or is this just because obviously the large businesses can act on their animal spirits a lot quicker than a small business can. So economically, I think it's a slow walk to what that has to do with how the economy grows on the small business side. But what do you think it means for the index? Because I started some research, got nowhere with it. Mike Arnold's going to help me out with it in the near term, about seeing, I think I'm seeing negative stock market returns on small business optimism index spikes. So do you guys look at it? Do you see anything there?
Take that data with a big, huge grain of salt. We know it's political, that it is just correlated to small businesses tend to associate or tend to identify as Republicans. And so when you see Republican winning elections, you see a spike in small businesses. You see it collapse when Democrats get elected. It's a classic watch what they do, not what they say. So, it's one of those where, yes, the sentiment helps and it shows up in different areas. I've talked about this in the past. I remember I used to cover the machinery stocks, and 2 weeks after Trump got elected in 2016, you started seeing auction data, auction prices for tractors spike post the election because people were feeling more confident. So it does show up in prices. And one of the best leading indicators, or a really helpful leading indicator of the unemployment rate, is small business sales. Small businesses, after all, are the largest employers in the US in aggregate. And so if small businesses are reporting weaker sales, then it typically is coinciding with a rise in the unemployment rate. And it did do that over the course of the last year. The unemployment rate rose as small businesses were saying, the sales are starting to weaken a little bit. So, but it's a question of, do CapEx intentions, does overall sentiment actually translate into higher reported sales? And that's the question of, does animal spirits actually create a better business environment and better sales? And that's what we'll have to continue to watch in the data as it progresses, because that sales index didn't jump nearly as much as like the softer portions of that data did.
So I want to jump into something else, if I could, Jimmy, real quick, because one of the things I find interesting about politics is, that, again, we're speaking on, what's today's date? The 28th. So you guys won't see this for 7 to 10 days, somewhere in that range. And I want to read something from your note, but real quick, that Trump-Vance team is going to take credit. I'm looking at a crude oil chart with 6 of 8 days lower, and they're going to take credit for immediately dropping the price of crude oil as soon as they took office, which I think is hysterical. Just so you guys know, Jimmy and I were positive Trump for this particular election, not for all of them. Don't cost, MAGA. That's what always happens whenever we bring up Trump. You guys are MAGA.
Don't hate Trump, you're MAGA. In their
exactly.
mind.
But he has nothing to do with the early drop in crude oil, just for that focus. But you wrote in your January 25th note, as we discussed in our 2025 outlook, we think the recalibration phase of the Fed cutting cycle is mostly over. Then you went on to explain it, but can you explain it here too? Because we're going to have a Fed decision tomorrow. Again, that'll already be out by the time people are watching this. Also, is Powell really a deadhead?
Yeah, he is. Yeah, he was seen at a dead show up in Saratoga, and supposedly he is quite the guitarist, I have heard. So a talented individual. So we wrote about this idea that the recalibration phase is over for the Fed. And the meaning behind that is that if you go back to the September meeting where the Fed cut rates by 50 basis points, the phrase that paid for Powell was the word recalibration. He said it a ton of times. And so what we wrote about back in December of, okay, what does that mean? What it means is this idea that we can cut rates because we can, not that we're cutting rates because we should. Recalibration means that we have room to ease policy to get back towards this idea of neutral, and the concept of neutral being an idea, it's a state of mind, less than something measurable. But this idea of neutral, that we can get back to it by cutting rates, not because we're seeing this uptick in unemployment. It's a preemptive kind of cut, but it's recalibrating policy back to neutral. Our argument has been that now that you have cut rates by 100 basis points, we think that they're a lot closer to neutral than they think that they are. And the evidence for that is that the entire time that the real real Fed funds rate has been positive, one measure of how tight or restrictive policy is. The entire time that real Fed funds rate has been positive, the entire time that the Fed funds rate has been above their own current estimate of neutral, the U.S. economy has grown above trend. The U.S. economy has surprised to the upside, and financial conditions have remained easy. And so our argument is that there is no way that if the Fed were as restrictive as they say that they are, that you would see financial conditions be as easy as they are today. And remember, financial conditions include yields, the dollar, equity valuations, equity volatility, and credit spreads. There's a couple other things in there. Yields in the dollar have tightened, which means that equity valuations, equity volatility, and credit spreads have actually eased much more than what yields and the dollar would even be signaling. And the argument would go is that if the underlying economy was actually weak because the Fed was that restrictive, credit spreads would not be at a 20-year low. They wouldn't be, because you would be pricing in potential risk to incomes, to overall earnings, which would make debt levels more strenuous for the companies that are borrowers. So our point is they're not that tight, which just means that we are in a holding pattern. Do they continue to cut because of political pressure? Do they continue to cut because they have cuts marked down? Possibly, but the risk that they have is by cutting, they could overheat the economy. That's a whole different other, I could talk about out of two sides of my mouth on whether or not that would happen, because I think that you could make two arguments in either direction of how that could play out.
So two things real quick. Number one of the reasons that we love to have you on the show is I pull out my nice t-shirts. The second reason is
that's your nice one?
Yeah.
Score one for Cameron.
That's my nice one. I mean, it's pretty nice. It's like a bluish purple. It's gorgeous.
I think it's lovely.
It's also,
I mean, you're bringing back the deep V like it was 2010, and you're wearing skinny jeans, and you have your keys on a carabiner, and you got some Chucks on.
I don't have Chucks on, and I'm not wearing skinny jeans, although I always wear Jordans. No, I do own a lot of Chucks, but no skinny jeans. Come on, you know me. Stop it. The second question is
it's a deep
comments.
V. You're
It is. It's a good one. It's an Italian
very
thing. I feel like doing a little of this.
My wife says when I wear a regular t-shirt, I look like I have a turtleneck on. It's funny. The second reason is you almost always answer my
putting it up, Jimmy. Come on.
I did.
This is a decent show, okay?
This is not a decent show. You always answer my follow-up before I ask it, so I just want to kind of pin you down between tight or loose. What is the Fed right now?
I think that they are loose-ish. Okay, so this is this actually, it's a loaded question. I think that they have been loose in aggregate. I do not discount the pain that you see in small businesses that rely on bank loans and the higher cost of debt from that. I do not discount low-income households that rely a lot more on revolving credit card debt, the pain there. Do not discount the pain of people looking to buy a new home that see very high mortgage rates. All of those things have weighed on economic activity in pockets, but not in aggregate. And the reason it hasn't weighed on in aggregate is because the biggest borrowers and the biggest households all have termed out their debt, which have made them far less sensitive to short-term interest rates. Is a key part of our thesis. The last 2 years, 23 and 24, we said no recession because this economy is not as sensitive to short-term interest rates as it was in prior cycles. And so I do think that 2025 and into 2026, really 26 is when this level of interest rates will actually start to bite. And so I think that the nuanced answer to your question is that they have been loose, but they will be getting progressively tight because what's happening is some of that debt that was issued in 2020, 5-year debt, is starting to get refinanced. It's not a lot compared to what's going to come in 26 and 27. And I do wonder how much of the strength we saw in housing, for example, was people saying, you know what, the Fed's going to cut rates, interest rates are going to drop. I'll take a floating rate loan or I'll get a mortgage and I'll refi when rates do drop. And it's a survive to 25. We saw it within commercial real estate. We saw it within a lot of businesses just saying, let me just hold on until 2025 and everything will be fine. And if we don't get those rate cuts because the Fed stays higher for longer, I think it will start weighing on economic activity. So maybe the Fed is smart after all by cutting rates as much as they have to say, let's get ahead of that. Maybe they are appreciating it, but they also use a very, very they use the Taylor rule, which doesn't account for these different balance sheet dynamics. So I think that we have to realize that, time is something that's a factor that will cause this to be dynamic. And I do think that eventually the level of rates will weigh on economic activity, but the lags this cycle are longer and far more variable.
So
no skinny jeans. We're not in Brooklyn.
Yeah, no. Yeah, my jeans
Nobody
look like
wears skinny jeans
I have one in the 80s.
Anymore.
in New York.
Anymore.
Just for the record.
Anymore.
We're far cooler than that.
Good.
No, whatever.
Okay.
This isn't Florida.
Talking to a Florida
I'm going to
girl.
forget. I'm going to forget if you keep going. I got the two things I think is important. You mentioned that you think the Fed was too loose, but you didn't mention the 36.6 trillion and the profligate drunken sailor spending that has boosted some inflation. Are those two things connected in your mind? Is the Fed, should they be tightening in your mind? And is part of the fact that they're spending money like drunken sailors part of that?
Look, we cannot ignore the fact that you now have 22% of Treasury debt outstanding in bills. And that was done in order to keep the liquidity dream alive. It allowed liquidity to stay in the banking system because of what was going on, reverse repos and bank reserves and all these fun dynamics that there are far better experts out there than me on this topic. But you have this huge set of bills that is going to continuously experience high interest rates because it's short-term debt that gets refinanced all the time. So no wonder there is desire by when Trump says, I will demand interest rates be lower. And he can't do that. I mean, I guess in some ways he can, but it's a bit of a different discussion.
You
but
demand it. You just can't have an effect on it.
Yeah.
You can demand it all you want. Right?
You can demand it all you want. And look, I think we have to appreciate, though, Powell is a dove. Like, don't forget, every time that there's been an opportunity for Powell to get ahead of potential weakening, he has done that. So if he digs his heels in and says we're independent, he has a situation where we do know that it doesn't take a lot for him to flap his dove wings based on the way that he's responded to data in the past. So we could see further interest rate cuts, even if you see a slight increase in the unemployment rate, but then that will be for a reason. If unemployment continues to fall or stay about where it is, we don't think that they're going to cut, even if the Treasury really does need it. And the biggest wild card as we move through 25 as a bond investor is what Bessent does with that bill issuance. And there, of course, before he had the job, he talked about wanting to term out the debt. And look what happened in the third quarter of 2023. Yellen increases coupon bond issuance by a slight bit, and the 10-year Treasury yield went up over 100 basis points in just a couple of months. So if you were to see Bessent come out and say, we're going to increase coupon bond issuance, I don't think he will, simply because he understands markets and he understands the implications and understands macro markets really well, that they're going to try likely to come up with some creative solution to deal with this bills problem. But it's a delicate balance. How can they get it lower, get interest expense lower? It's now over $1 trillion while also not draining liquidity out of the financial system as the Fed continues to do QT, as reverse repos are already drawn down. This is a quagmire, and I don't know how they get out of it. It's maybe that Gordian knot where it's so complex, the only thing you do is to cut it in order to release the ox. But I don't know what the proverbial cutting of the Gordian knot would be.
No, we got to make that up, and that'll be our saying. We'll be known forever as the cutting of the Gordian knot people. But anyway, though, here's a question. You might not want to answer this question. I'll be perfectly fine if you don't. Just say pass, because this is an opinion of Cameron Dawson. You mentioned them zapping up all the liquidity from the short end, draining reverse repos. A lot of it was done in the last 6 months or so. Do you think there's any sort of oh yeah, we're handing over to your guys. Good luck selling 7 years on out now that we've zapped everything on the short end? Do you think there's anything nefarious in the way they conducted themselves on the way out the door?
Yeah, maybe the word to use would be on purpose.
On purpose? Yeah.
Right. I look, I do know, and this is building on, this is Dan Clifton's work from Strategas. He talked about how in the summertime, there was a pulling out of all the stops and getting money funded, getting different kind of programs, getting money out the door in order to get things juiced going into the election.
No question. Right. Yeah. Go on. Yeah.
But at the same time, Dan also argues that today they're sitting on a big liquidity bazooka. And so there has been a build in the Treasury General account, and he argues it's about $700 billion of build in liquidity that can be drained. So I don't know if the position that Yellen left Bessent in is as bad, because they have this liquidity buffer that allows them room to breathe, given that we've hit the debt ceiling and given that we're going to go into these debt fights, that there is this bazooka for them to play with. So I don't think that they've been left completely high and dry by the prior administration just based on that buffer that exists today.
But they acted in their best interest. But you think that they could have. Yeah. Robert?
Yeah, I want to jump back to politics real quick, Cam, if we could. I just changed his name to Friend in case anybody knows him, and you're not going to recognize the picture, but this is what I get from one of my anti-Trump friends about what's going to happen. Now, I don't even know if I'll respond to that one. But the gist of his Trump-hating argument is, and he hates him on a personal level, that's why I call it that. But the gist of it is tariffs and the deportation of illegal immigrants, undocumented workers, however you want to refer to them, is going to crush the economy. What's the truth about those two subjects, if you have an opinion?
Well, I do think tariffs and immigration certainly are wild cards as dampeners of growth and inflation. And you can argue that if you want to you can argue the merits of those policies for what they do for society or what they do for the structure of things, all you want. I have no say, no opinion. My opinion doesn't matter. What we do know is, as I mentioned earlier, the influx of low-cost labor has been a key reason why we've been able to accomplish immaculate disinflation over the last 2 years. So if you remove that low-cost labor, you do set up the risk that you retighten the labor market, you introduce wage pressure, and wages become a source of inflation. And wages have not been a source of inflation over the last 1.5 to 2 years because of this dynamic. So that's a big issue. When you think about, how do you grow an economy? It's labor, it's capital, and it's productivity. And you take one of those out and reduce that, then you don't get as much economic growth. The other thing about tariffs is that there's all this debate as to whether or not they're inflationary and whether or not they impact growth. And the evidence is very suggestive that you raise prices on something, demand falls. I mean, it's simple supply and demand 101, and anybody who's taken macroeconomics 101 knows, that lost productivity in the triangle when you shift demand curves or shift supply curves in different directions because of tariffs. And so I do think that there is a risk that in order to pay for things like a lower corporate tax rate, that they pursue a wider, more sweeping tariff program that would effectively act as a regressive tax on consumption. It would have an outsized impact on lower income households. You might not see it show up in the economic data as much because they just make up a much lower portion of consumption. High income consumers, the top 20% generate 40% of overall consumption. They outpunch their weight. But here's the thing to watch with them. If the equity market doesn't like immigration policy and doesn't like tariff policy, and you see an equity market correction, we think the biggest risk to high income earners in the US is a falling equity market. We think that the rising wealth effect has been one of the key reasons why high income consumers have been able to spend so much. And obviously wealth effect coming from stocks as well as from housing. And so if you were to see a prolonged equity market correction because of a growth scare related to either immigration or tariffs, then that could be something that becomes a self-reinforcing, feeding on itself kind of negative. So look, I think that my goal always in any kind of political analysis, my opinion doesn't matter. We just try to get it at the numbers. Sure. And the numbers suggest that both of those sets of policies could be disruptive. And it's a matter of whether or not the administration thinks that disruption is worth the outcome.
So two real quick follow-ups. What has been the driver of sticky services inflation, if not wages? And I mean, you said inflation in general, so I'm actually not disagreeing with you necessarily there. And number two, if is that what people are missing in the tariff thing? Because I obviously look back to 2016 term and the tariffs didn't cause much general inflation. Also, we were at a very low level to begin with. And there's not a real lot of data to go on as to whether the tariffs actually caused inflation. So is what people are missing what you said? If the prices rise through tariffs, people's demand drops and they switch to a different product or they don't buy, which brings prices back down? I mean, is that why we haven't seen it?
So what happened in 2018, it's good to remember that the tariffs were very focused.
Yeah.
And they were, in some ways as well, much earlier in the supply chains. So if you have steel tariffs, yes, it filters its way through, but you have all these opportunities throughout the supply chain for it to find productivity, and part of it gets passed on and then it gets dampened by the time it gets to the end consumer.
And like some cases, they were very short term too, like the threatened ones on French wine and cheese, for example.
Yeah, and so we saw with washing machines, washing machine inflation went up and then it started to drift lower as people bought fewer washing machines. The other thing is that if you look at the aggregate inflation data in a year like 2018, people will say, "Oh, well, we created these tariffs, but inflation fell." And yes, it did on a headline basis, but that's because oil prices were lower. So you have the masking of some of the goods inflation. What you can actually see is durable goods inflation troughed, and it was in deflation, and it actually moved into positive territory. So the argument would go, if you see broad tariffs on everything, 10% across the board, a lot more of that is direct to consumer. A lot more of that then means that what do you switch to? And Besant has even talked about, tariffs are not a problem because people will switch to other things and they buy less of something and it all kind of evens out. But we've never done blanket tariffs on major trading partners.
I can't find data. Yeah.
And so I think that if that is something that is pursued, we should expect inflation from two aspects. Not just the inflation that comes from the price of the tariff itself, but from the supply chain disruption as people try to get around the tariffs. And if it, that's where some people will say, look, this could be like a COVID era type of supply disruption. I doubt it will be that severe. If people are talking about it being that severe, that might be a little bit of an exaggeration. But I think to an extent, the reorienting of supply chains in the face of tariffs could certainly cause there to be a reuptick in goods inflation.
Okay, so this is Donald Trump in 2016 made this wild claim that other countries pay for the tariffs. What he meant, in my opinion, was that other countries perhaps would lower their prices a certain degree to compete with American products if they weren't at the right price point. So in that respect, in some way, in whether it's he's this much right or this much right, but there's a little bit of validity to what he's saying, correct?
I don't know. I don't have any data to know one way or another. So I have no idea. Okay. I'm sure that through competition, that those that can lower their prices in order to make it as flat as possible certainly saw the ability to gain market share by doing that. But the economic benefit of lowering costs just to keep the same price, we could debate it. But look, we also saw people get around tariffs by moving production or final distribution to Vietnam, for example. So there's ways that people got around it. And I think that what we should debate is the economic efficiency of getting around tariffs and what does that lead to overall economic benefits at the end of the day. And most trade economists would argue no, but then there are certain people who would argue 100% yes. And a lot of it depends on capital flows as well throughout the globe and how sustainable funding deficits, et cetera, trade deficits. It's all stuff that are some great experts out there that have distinct views. So,
So, and they can all be a little bit right and a little bit wrong all at the same time because it is a mixed bag, I think. But I want to switch now to when you look at 2025 going forward, what do you like the best? What do you think are the areas that maybe have been underloved that are going to do well now, ones that have been overloved? What do you think?
Yeah, so we made a call at the end of 2024 in our portfolios where we said, look, the parabolic move in growth in December was just unsustainable. And so we reduced our growth weighting and went into value and just said, we don't really like the value story from an earnings perspective, but we have a sleeve that we can do things tactically like that. So we made that swap at the end of the year. If we talked in a week, we might close that out. We've seen value really outperform growth. You've seen a 900 basis point spread between value and tech, which is what we use for the rotation. So, that I think is compelling in the sense of a certain degree of mean reversion, but I wouldn't put that in the camp of it's going to last all year. So I think with all of these kinds of rotations, the old mantra, we're here for a good time, not for a long time, I think is what we're going to have to use, because our overall call for 2025 is that we have a wide choppy range. We're calling it the talking heads market on the road to nowhere. That the upward sloping market that's been really powerful, 20% a year for the last 2 years, is going to start to level off. And our argument, and we've been saying it a lot, is like, look, it's going to matter less where the market ends at the end of 2025 and a heck of a lot more what you do with the volatility along the way. And that we do think you're going to get volatility. We think you got a taste of it on the 27th. It's likely that we'll continue to get volatility, whether it's from policy, whether it's from company earnings, whether it's just from market structure. And I think being ready, willing, and able to take advantage of that opportunity, that volatility makes sense. We're not making a recession call. We haven't made a recession call. We reserve the right to make to change our minds. But because we're not making a recession call, we think weakness is viable. But would note that with positioning being so crowded and with leverage, if you look at FINRA margin loan balances, they're up 45% in the last 14 months. So people are adding to the market. They're all in leverage ETFs, YOLO calls, zero date expiration options. All of these things suggest that there is a lot of optimism already baked into this market, which the last point I'll make is that's why we called our outlook for 25 great expectations. Doesn't mean that you can't see upside, but when you have such high expectations for something in the valuation and the positioning and the growth forecast, it leaves very little room for downside surprise. So you can get upside if everything goes right, but be prepared that if you get a little bit of bad news, like a new app out of China, that it can cause a lot of volatility.
So real quick, just is it fair then to say that you guys' outlook is sort of for a sideways correction, a macro sideways correction? In the equity markets for 2025?
A consolidation year that looks like 2015, 2018. That's the parallel that we're painting.
Do you guys watch fund? This is actually my last question, Jimmy. Do you guys watch fund flows at all? A friend of mine and a friend of the show, Tim McLean, asked me over the weekend, and I don't talk business over the weekend, drives me crazy. But he asked me if I follow fund flows and I don't. But he said he sees a lot of insider selling. I'll look for insider selling when I'm looking at an individual stock. And he wanted to know if I knew anyone that watched fund flows. And I thought I'd throw it to you since we were talking to you.
Yeah, I mean, that's been really notable. As we've seen buybacks tick up, you've seen insider selling start to tick up as well. So the same CEOs and CFOs who are buying back their stock are now selling it in their PAs. And, maybe you have a bunch of people ready to retire. Maybe you have some tax and estate planning. You could see people, I actually hadn't thought of this, but you have the potential expiration or step up or step down of the estate tax exemption. It could be that these people are selling stock or potentially changing their asset allocations because of making gifts as part of the estate tax. Who knows, right? That could be part of it. So, look, I think that has typically been a sign of a potential negative sign. It doesn't have a 100% hit rate. So insider selling is not a fail safe, but it is good on insider buying. It's actually a better indicator when they're buying. So when insiders are buying and the market is super weak, usually that's a sign that something is happening that people aren't paying attention to. But it should give us a little bit of pause to think so the guys running the businesses are disinvesting from these companies. What does that mean for little old me?
That matters. I agree. All right, this has been good. I know you're not 100%, which I think you're not 100%.
Yeah, can't tell.
Way
Can't
better
tell
than
at all.
everybody else's. Let's finish
I
on
did
something.
that to set a really low bar.
Oh yeah, you exceeded that bar. But I have more important questions real quick before we go. What is the best 2 TV shows you watched over the last year?
Oh goodness, I
Bobby, this
don't
is going to go
watch.
to you as well.
I
Yeah,
don't
I
watch
got
a lot of TV. I love cozy murder mysteries.
Okay.
So I just watched Only Murders in the Building.
My daughter loves that. Yeah, is that any good? You liked it?
I love it. The Diplomat I watched with my family over
I love
the
the
Christmas.
acting, but I started to lose like what the stories were. But the acting was great, I thought.
Yeah, they got increasingly complex. And then look, my grandma and I are wholly and completely devoted to Murder, She Wrote and Agatha Christie shows.
my
And that's what we
God.
like the
Oh,
most.
I did not expect that. Bobby, what is your best 2 TV shows?
So this one, a lot of people know about already. I just got into Ted Lasso, and it's just
Ted Lasso's great.
Welcome to the party.
fantastic.
Like,
Yeah, I
what
know.
year is it? What year
I
are you?
know.
Are you? You're definitely living in a different time. The VNet.
Yeah, for sure.
I just watched Ted Lasso.
You know, I say it to people my age all the time. We had it all. Now sucks. A long time ago was way better. So, but then there's one. They're about to come out with a 3rd season with what is his name? Jason Segel and Harrison Ford. It's called Shrinking.
I love that. I watched it. Yeah.
Shrinking is
That was great.
phenomenal.
It's such a good
funny,
show.
and then I start crying, and I feel like my V's not deep enough because I'm crying into my chest, and it hits my shirt.
Yeah.
I was going to ask you
My
about
new
that.
book
What
of
is
the day, which is Where Are Your Boys Tonight? The Oral History of Emo's Mainstream Explosion. So if you're feeling a little bit emo, I'm right there with you.
I'm never feeling emo. Well,
You
I
know-
don't even know what emo is, and I don't
Do you know
want
why
to.
shrink skinny jeans don't work for guys like Jim and me? You can't fight in skinny jeans.
No,
We're
because
always
you rip,
saying
and
something
then it's
stupid.
embarrassing.
We're
You're
always saying
all-
something stupid. You can't fight in skinny jeans. So you just
Yeah,
always
but
gotta be
if
aware
you're
of that.
fighting in skinny jeans, it probably just looks like in GoldenEye, the N64
Yeah.
game, and the version of
100%.
slappers only.
100%.
It's so funny that you mentioned that. About a year and a half ago, I had a beef with one of my good friends at my bar. He was hammered, and he made his allotment of short jokes. And I said, that's 3 short jokes is all you get. You can't have a 4th. And he made a 4th. So I grabbed him by the beard, and we were looking, and people had to separate us. But then the next day, I said, if you're coming by the bar, I just want to know if we still have a beef because I want to know what clothes to wear. You know what I mean? So all I want to know is there's different outfits for a beef and not. But anyway, that was a bad
And
idea.
constant black T-shirts for me. It's always the right choice.
This just there's an emo lyric that goes, if your boyfriend's got beef, tell him I'm a vegetarian and I'm not scared of him. I amended it slightly so I could be a lady, but
All right. Okay. I'll think about that. Well, thank you so much for being here. Where can the people find you? Where's the easiest way to find you?
I'm on X at Cameron Dawson, LinkedIn, Cameron Dawson as well. And then you can go to the New Edge Wealth website and sign up for the weekly.
Good. And if you guys aren't following her yet, do it immediately. I'm sure most of you are because everybody does. She is a wealth of knowledge all the time. Thank you guys for joining us. By the way, none of this works without the support we get from everybody. We get 80,000 to 100,000 views a show now. We are so proud of that fact, and we are so grateful and humbled by your support. Bobby and I were in legacy media for quite a long time, and you know the problems we had with it. We want a platform where we can say whatever we want. Our opinions might be bullshit, but they're our own opinion, and they're unfiltered. Thank you to our sponsors, Hardcore Italians. Use our promo code FU for Finance Unfiltered to get 15% off. And the show is brought to you by Independence Arc Farms in Arkansas, an independent, grass-fed, grass-finished beef. If you haven't had it yet, I don't think you really can say that you know that much about beef. As soon as you taste it, you will understand the difference. Thank you for joining us on The Future's Edge. I'm Jim Iuorio. That's Bob Iaccino.